Well, as you know, many investors already are invested in emerging markets. Emerging market equities represent almost 12 or 13% of a global index. And so people in their overall portfolio positioning will be invested. I think volatility and the current market environment is always difficult to gauge how much you should be invested in emerging markets. And at this point in time, I'm not sure I'm ready to recommend anybody piling in. We're in a very volatile period right now. We think that a lot of value is being created with the recent sell-off. But there are a lot of uncertainties around the geopolitical situation as well as underlying issues in emerging markets that make it a time, I think, for investors to look closely at the asset class and maybe consider investing when we see a few more signs of stabilization in the marketplace. Well, we don't tend to move our portfolios around very much. Lazard Asset Management, we have a variety of strategies in emerging markets for each investor to take a look at and decide what they're most comfortable with. We have a relative value strategy, which looks at financial productivity related to the price earnings ratio. We have a growth strategy that looks at the price earnings of the company relative to its earnings growth rate. We have a core strategy which looks at it's style agnostic and looks at a variety of factors before deciding on companies. And then we also have a quantitative strategy which tries to neutralize the sector and country risks and focus on the underlying stocks. Each one is volatility slightly below the benchmark, so lower volatility strategies. None of our strategies hedge the currency because of the cost of hedging is very high and it tends to be more tactical. And we tend to invest for the long term. While we do have different time horizons, we think that the ultimate choice is that the investor should look at their time horizon and then pick the appropriate fund for their level of risk and for their time horizon that they're interested in investing in. Well, clearly 2018's been a difficult year for emerging markets. It's one of the deepest sell-offs we've seen in many years, and really in some sense rivals some of the crises of 94, 97, 98, and then even in the global financial crisis. So while the rising dollar, rising yields in the United States and the increase in the US dollar has put a very negative strain on emerging markets. There have also been issues domestically that have not helped. So such as sanctions applied on Russia, significant currency weakness and inflation in Turkey, Argentina, and then we've also gone through a pretty dramatic election cycle, particularly in Brazil and Mexico, which has created a lot of uncertainty. We think that this is an opportunity, again, for investors to look at the current environment and maybe pause and wait to see a couple of things occur. What we would be looking for as investors in the market is a stabilization in the dollar. We think that the dollar has run fairly dramatically higher and has tended to moderate a little bit. The Federal Reserve by all indications, is still going to be looking to increase interest rates in the United States. But it seems to be they may be more moderate going forward than the markets anticipated. So we may see a slowdown in terms of the pace of interest rate increases. And then the geopolitical aspects around the trade wars that we've had, initially with the NAFTA between Mexico, Canada, the United States, South Korea, as well, and now the trade war with China. That's a concern for us going forward. We have to see that stabilize a little bit because it is beginning to impact growth rates globally as well as growth rates in many of the emerging markets countries. I think a lot of that has been priced in. We imagine this morning maybe we may see a little further run in the market It's difficult to predict markets over the near term, which is why we do look at it over a longer term. I think that the key to Brazil will be if the new president is able to implement the fiscal and monetary reforms that are needed in Brazil to really put the economy on a much better longer-term footing in terms of a more stable growth environment and a better fiscal situation for the government at large. This means they need to address pension reform, in particular labor reform, and to the extent that the new president can address those issues effectively, then we could see significant long-term outperformance in Brazil. Argentina is not part of our benchmark officially. It is still a frontier country, but it is, we are seeing more opportunity there, or we have invested there in the past and do own some companies there. I think Macri has a difficult position. He's lost some faith from the market because the pace of reforms has slowed a little bit. He does have the backstop of the IMF. Obviously the currency has sold off dramatically and interest rates are extremely high. So again, we think a lot of the risk there has already been priced into the market. But as in Brazil, the reform process needs to continue to gain momentum in order to turn that market around.